Hey everyone, welcome to week 12. We're looking this week at Ireland and the European financial crisis, a topic that is close to my heart, not least because I'm Irish, but I think it's a really interesting topic to look at in the context of the class so far. And this definitely is a topic that I have been sort of doing some of my own research on in recent times. It's my hope eventually to have a book actually on this topic, and so I wanted take the opportunity rather to sort of take some of the themes that we've been looking at in this class so far and really bring them to you, connect them to you through the lens of the case study of the Irish experience, specifically of a lot of the things that we've been talking about in this class. So we started off talking about economic integration being kind of almost a theory, a belief prevalent among the European Union's founding fathers that, through spillover of various sectors, you could have you could have a European integration that was led by economic sectors. And here we are now in several years after the events of a serious financial crisis that have, in no uncertain terms, put to the test so many of the hopes and dreams of those founding fathers. And I think another theme that can be talked about here is just how important neoliberal capitalism has been for the project. There's schools of thought that would say that capitalism was inherent to the EU from the get-go. Of course, that's true. The European Union is as much a capitalist project as any other in the capitalist world. That's I think can go without saying, but I think there's definitely, the material that we looked at in the course, in no uncertain terms, I think gives us an impression of just how important the neoliberal chapter of capitalism has been for the development of policy response to the financial crisis that's ongoing. So this is, again, just an opportunity to talk with you about a particular case study that I think really animates so many of the concerns of so many of the theorists and authors that we've looked at in this course so far. So let me tell you a little bit about the Irish financial crisis then. So it's frequently argued by political leaders and commentators pretty much across the spectrum in Ireland that while there were, of course, numerous technical causes for the Republic of Ireland's financial woes, which really sort of developed in 2008 but have been ongoing ever since, and those would have included, a narrow tax base, lax oversight of the banks, perhaps not a very good fiscal strategy, to sort of low tax, low spend kind of model, very, very different to the model that most Americans think of when they think of a European country. Americans have Sweden in mind or Germany in mind when they think about Europe. But Britain and Ireland, but especially I think even more so Ireland, have had much more free market kind of economies, or at least aspiring to anyway, certainly in the last 15, 20, 30 years even. What's remarkable about the Irish financial crisis, and this is a theme I'm going to keep coming back to, I think, as we go through this lecture today, is the fact that while all those factors have been listed by many critics of the government's response to the financial crisis and also the government's economic management in the years before the crisis, one of the main things that really keeps coming up in analyses of what's happened in Ireland is this idea that the crisis was kind of a cultural crisis, that it was a test of Irish culture. The Minister of Finance, Brian Lenihan, in 2008, famously went on the news, a primetime news program, and in November that year said that the cause of the Celtic Tiger was not the fault of any one specific group or class of people, but rather it was the fault of the nation, right? The fault of everyone. And he sort of blamed what he saw as a weakness of the national character. And in his famous phrase, he said, "We all partied." You could sort of ask, what does he mean by that? And of course, as you think about that, you might remember Mark Blythe, who we've looked at in the course, saying that austerity kind of works on the logic of a morality play. And if you remember his YouTube video that we looked at, he said that austerity was kind of seen as the pain after the party. And of course, it's just really interesting. I hope you'll see the way that resonates. You have elites like Brian Lenihan, the Minister of Finance in Ireland at the time, saying that there was this party that we'd all had in the good years before the Celtic Tiger. And I think it's just interesting that those kinds of discourses are so clearly anticipated by Mark Blythe. So, it wasn't just the Minister of Finance saying this. Like, everyone was saying this from the Prime Minister on down. And what you have to understand is when you say that everyone has partied, it means that it's everyone's responsibility, right? So that means that the call can then go out to the population of Ireland, to the workforce of Ireland, that they have to share the burden of setting the nation's finances back to rights. And you might say, well, that sounds reasonable. The country's in trouble. Surely everyone should buckle down and do the right thing. So the frame then clearly is one where exactly everyone has to do the right thing. What would the true Irishman do? The true man proud of his country, wouldn't he sacrifice? This is kind of like almost like you're looking at the situation almost like it's a wartime initiative, right? So the true hero of this moment is going to be the person that can internalize the logic of this proposition and say that austerity is the pain after the party, or the justly deserved medicine for the collective sins of the past. So there's a certain kind of confessional element to this, right? And this is this idea that the subject, the citizen, is part of a cultural formation that has demonstrated a certain weakness of the will, right? That we did party, that we lost the run of ourselves, that we spent too much, we partied too much, we borrowed specifically too much, and therefore accept that a resolution to this crisis is necessarily going to be one that presupposes a certain internal work, right? Not just that you have to pay the money or tighten your belt, but that you have to look inwards and find within yourself this truth that you're part of the problem, right? That you were one of the people that partied. So interestingly, then, this we all partied theme, or if you want to use the social science language, you can say trope. This partied theme, this we all partied theme. Well, there's a couple of interesting things we can say about it. First of all, in a sense, it's a refusal to apportion blame, right? It's saying that there's no one sector that caused this problem. But interestingly, the same thing could not be said of the debate that took place in Ireland over the terms of the nation's recovery. So you have the debate over the causes, but you also have the debate over what we have to do about it. And so when you look at austerity in Ireland and you look at who's been asked to sort of pay the price in terms of the nation's recovery, you can see, I think, very clearly that if you examine the public discourse surrounding Ireland's efforts to come back to economic well-being, that certain specific groups have been sort of targeted as less heroic. And one of those groups that I'll talk to you a little bit about later in the lecture is the public sector, i.e. the government employees, the civil servants and the people that work in government services. Because typically they might be, at least in the popular view, they might be better paid. And so, it's taxpayers' dollars or euros, so to speak, that pay those wages. So naturally then, if burden sharing is the mantra, then these people have to tighten their belt too, and maybe even more than everyone else. So we all partied is the first theme, and then the refusal to apportion blame is the other, because everyone's equally to blame. Therefore, everyone has to tighten their belt, and so we have heroes and villains then in the history or the story of how the country is going to recover, according to the mainstream view of the world anyway. So one of the things that I wanted to argue, and I sort of have been developing this point, and I'll talk with you a little bit about it as we go through today, is that consensus, that idea that we all partied and now we all have to pay, is a bit of a puzzle, actually, because, well, for three reasons to be specific. First of all, because it's a shift in the kind of common sense that was circulating during the years of the so-called Celtic Tiger. What was the Celtic Tiger? That was the pre-crash economy that ran from the late 90s up until about 2008. Typically, it's said to cover about 15 years up to 2008. And so many scholars sort of talk about there being two phases of that performance. There was a pre-2001 performance, and even the critics of the Celtic Tiger sort of hold up that pre-2001 performance as evidence of the country sort of having gotten it right. That at that point in time anyway, that the Irish economy was doing well, and it was doing well for the right reasons. Post-2001, as we'll see, there were reasons why the economy was doing well for the wrong reasons. But so that's the first theme. The second theme that sort of puzzles me is that the discourse of generalized irresponsibility that we've been talking about here, this idea that we all partied, actually neglects some of the fundamental historical facts of how the Republic's economy was configured and governed over the years. Now, a lot of scholars have argued this, that Ireland has basically, since the time of its founding, been a fiscally liberal country, with a low tax economy and a fairly low rate of investment in social services. Historically, of course, it's had very weak unions, and so in the course of the nation's history, there's never really been a mobilized left, so to speak, right? So this contradicts, to a certain extent, the mantra of a general cultural failure, because it can't be the truth that we all partied, because economic planning has not been the province of everyone in the country. It's largely been an elite affair. Despite what the elite may say, Ireland's economy has not been democratically sort of run. The stakeholders in Irish society have not had a seat at the table, so to speak. So if they haven't had a seat at the table, then what are we talking about here? Who are these people that have failed? It's a very important question. And then thirdly, we have this question of the roots of the homegrown crisis. If we all partied, then what you're saying is that what was going on in the rest of the world has nothing to do with the story. So that doesn't seem to be true either, because you can't so easily disentangle global finance from what happened in Ireland. What was already in America, for example, in 2008, also a huge financial crisis that arguably started the whole thing. We'll talk about that in a minute. But since the 1970s, through the course of globalization and various projects of so-called neoliberal or supply-side economics, You've had deregulation, and that was going on all over the world, largely pushed by international monetary institutions like the IMF, World Bank, and of course, while we had seen financial crises in the third world and places like that, the Europeans, the Americans had never really experienced anything like this in the neoliberal time frame. So it did sort of come as a shock to a lot of people to suddenly find that the way the economy had been configured was so prone to risk and failure. It was definitely surprising to some people, and so there's been kind of a sense that it can't be the theory that's wrong, right? It can't, the economic theory is the one we've been living by for 30 years. It can't possibly be that that's the problem here, right? It has to be that maybe specific people were corrupt, that we had some, as they say, rotten apples in the barrel, but the barrel itself, of course, is fine, right? And so for that reason, Ireland has sort of stood out as being labeled as one of these rotten apples. You have a New York Times headline in April 2005 where they argued that Ireland had sort of become too deregulated, and it was now, and I quote, the Wild West of European finance. Sort of making it out like a Western cowboy film. And of course, we all know in the Wild West there was no law. There was a lawlessness, and so Ireland, the Irish economy, had sort of been, according to this theme anyway, governed as a lawless economy, which meant that you could do whatever you want and corruption wasn't going to be punished and that kind of thing. So there was a tendency then to sort of look at Ireland as a rotten apple in the barrel, and I think that needs to be questioned as well here, because one of the things that we've been talking about in this course, especially when we talked about 2 weeks ago, we talked about how the European economy had been set up. Well, you know that the 1992 Single European Act brought in a lot of mobilization of capital in Europe. And so Ireland's reputation for so-called light touch financial regulation was really only earned and only began to be earned subsequently to the implementation of banking reforms and financial reforms that were actually demanded by the Single European Act in 1992. So that's kind of the setup here, we have these three puzzles, and they are empirical cause for reflection on this idea that Ireland, had a homegrown crisis, and the Irish only have themselves to blame. So, both within Ireland and also externally to Ireland in the international discourses on the subject, you find this idea that it's Ireland is the problem, right? And it's an interesting contrast, because you can talk about Greece, and they've had a very bad financial crisis the last few years, again triggered by the same kinds of conditions. Obviously, there's nuances, and it's sort of specific. Some of the specifics are particular to Greece, but a lot of them are shared as well. And so yes, the Greeks have received austerity very differently to the Irish. They've been much more inclined to protest. The Irish have kind of internalized the international media's coverage of the crisis, and have sort of said, we did all party, and we do want to sort of take our medicine now, the pain after the party being austerity, right? As Mark Blythe says. So and that's been the way it's been in Ireland, at least until the last couple of years, where we have actually started to see some protest. But perhaps, arguably, that's quite late in the day. And I'll talk to you about the protest at the end of the lecture. But just to sort of give you a sense of what I want to do today with you, I want to sort of take you on a tour of the two pivotal phases of Ireland's so-called Great Recession. And I want them to note the role of this narrative of generalized responsibility in each of these phases. Again, when I say generalized responsibility, I mean we all partied, right? This idea, this discourse, this concept that we all partied, it's been very heavily circulated by the government. But where does it come from, right? And so to explain that to you, I want to outline some of the principal components of the austerity narrative as a kind of a genealogy, like a family tree. And I want to argue to you that this is sort of an idea that's kind of been there since the beginning in Irish economic history, in the history of the country as an independent economic actor, independent from Britain, early in the last century. And I want to argue to you that these themes intensified after the 1980s in Ireland, because there was a recession in the 1980s, and you can see in the context of that recession some of the same language. And one of the interesting texts that really sort of bridges that 1980s experience with the experience today is a book called All the Pope's Children by David McWilliams. And I want to spend some time talking to you about that book. And note for you now that David McWilliams is a kind of an interesting guy. He's an economist. I don't think he meant to be a pivotal figure in this crisis, but it turns out that he is, because not only did he write this important book, which was a popular economics book, not very difficult for people to access. He specializes in writing accessible journalism, on economics. He's considered to be, this might sound shocking to you, but in Ireland we have a number of people who are considered rock star economists, because the financial crisis has been so bad that I guess people have turned to economists for an explanation. But economics is a terrifying subject for a lot of people. It's very technical. And David McWilliams is one of these people that has the skill, capacity, whatever you want to call it, to take this complexity and distill it down to very simple principles. And so his popularity indicates that a lot of his simple principles are being kind of absorbed by his audience. As you'll see, his role in this is not just that he wrote a book. His role in this actually is that he ended up being approached by the government for advice on how the whole thing should be handled. So we're going to talk a little bit about David McWilliams in the following few slides. It's not that I'm a fanboy or whatever. He's a decent guy. I've seen him speak a couple of times. But the point is that he's sort of, a lot of the story seems to revolve around him, and in a way probably that he wouldn't like to be associated with, but nevertheless it's true, right? So anyway, the we all party discourse, right? He is one of the people that in modern times has really been a early articulator of that argument. And I think, I don't want to blame him for it, but I sort of look at him as exemplary of the fact that between the 1980s and the financial crisis in 2008, there were people circulating this idea and people keeping this idea alive that the Irish were a nation of partiers, and when you would give them money, they would do irresponsible things with it. So this discourse definitely informed the way experts were thinking about the financial crisis, and you can see it in the way, for example, public sector workers were treated, the so-called Croke Park Agreement. Yeah, it definitely is, an example of a moment where this powerful interpretation was able to kind of do some work in the Irish political context and nudge, persuade politicians to introduce policy, to govern in a very specific way. So I want to spend some time in that first phase talking about austerity, the breakout of austerity, and the impact of this discourse of we all partied on that policy frame. And then I want to talk to you towards the end of the lecture about a second phase, what I call the post-Troika phase, because the Troika, of course, is the group of 3 European and international institutions that came together: the European Commission, the European Central Bank, and the IMF, the International Monetary Fund, that partnered to finance and govern the Irish austerity and make sure the Irish were going to pay back the money that they'd had to borrow in their bailout, which we'll talk about. But the post-Troika phase, which is when I think it's 2013, when the Troika leaves Ireland and Ireland gets its economic sovereignty back, that's when the recovery begins, the recovery from the financial crisis, really, and people start to see a little bit maybe more wealth coming back, or at least some people do. And the question emerges as to whether it's an equal recovery. And I think that's really where you start to see an uptick in Irish protesting, which, as I've said to you already, is kind of has been remarked on. The Irish weren't like the Greeks for the first 4 or 5 years of this thing. They were not protesting at all. So it's interesting that it was actually not on the way down with the economy that people protested, but actually sort of on the way up. That's actually a phenomenon in political science that's common to a lot of countries. So we have to talk about a couple of elections. There was the February 2011 election, which defeated one of the main parties that had sort of been seen to be guilty of being on watch when the crisis happened, and was seen to be kind of a corrupt party, a cronyist party. And then that election, February 2011, brought in a new party, not a new party, a party that had been around forever, Fine Gael, or FG as they're sometimes called. And they, in coalition with the Irish Labour Party, surprisingly, while they had talked a good game in the 2011 election campaign about, fighting austerity in some respects, or at least, trying to make sure that the crisis was, that the burden of the crisis, the cost of the crisis, was being shared by the other stakeholders, the international financiers and bondholders who had financed the Irish banks in the first place, to make sure that they took a haircut on some of the debt that the Irish people owed them, because that's the rule of capitalism, right? You place a bet, the bet goes wrong, you should pay. And I think it's clear that since 2011 that political party, Fine Gael, actually broke with some of its election commitments, failed miserably to get the bondholders to take a haircut, and kind of got walked all over by the European Central Bank and the Troika. So that's all part of the story I want to tell you today. And we're going to end up talking about the election that happened in 2016, the centenary year of the 1916 risings in Ireland, which are a famous sort of moment in the struggle for Irish independence. And it can't be gainsaid that the 2016 election really was kind of a revolutionary election in many respects, because if the 2011 election had finished off one of the major Irish parties, Freefall, the 2016 election really hit the two other parties, Fine Gael and Labour, quite badly. And now, since then, they're kind of limping along in a coalition that's on life support by other parties that are not part of government in the Irish Parliament. So, it's a really interesting time in Irish politics right now. And, well, today I hope to be able to share with you a little bit about why that's so. So, to give away the ending, so to speak, what I need to tell you, first of all, is that in November 2010, 2 years after the beginning of the economic troubles, the Irish economy was pretty much in freefall. GDP was really low, to an extent that was actually unprecedented relative to other post-war industrial countries that it could be compared to. The budget deficit was out of control. It was out of control. It was a 32% budget deficit. And the debt to GDP ratio, which is an important measurement of how a country is doing, had soared to about 110%, which means that Ireland owed more than it was making on an annual basis. 10% more that is was making on an annual basis. So in fairness, there was trouble all over the world at this time. There were shockwaves from the collapse that had of the economy, of the financial system that had really started in America. That was the ground zero of the economic collapse was Wall Street, and Lehman Brothers had collapsed in the United States in 2008. The shockwaves had been felt globally. And had exposed catastrophic weaknesses in the banking systems of Iceland, of Spain. Major British banks had gone out of business, and also there were British banks that were operating in the Irish market, like Northern Rock, Royal Bank of Scotland. They, had just basically gone to the wall and had to be nationalised by the British government. So what had happened here, right? If you don't know the story, the basic idea is that banks in Europe, especially in peripheral countries like Ireland, had been offered a lot of cash over a long period of time by international banks. And so these Irish banks were getting this access to cash at a very low interest rate. And of course, they were not very well regulated, which means that the amount of capital they needed to hold in reserve against a potential crisis was quite small, and it was not carefully scrutinized. So Irish banks then had started to take risks. They had so much money on their hands, they were able to start lending it to consumers, and specifically also to commercial property developers in the property sector. So mortgages, but also loans to property developers to build housing projects, to build kind of business skyscraper type buildings in the city of Dublin. And what that had done, especially in Dublin, was it had fueled an asset bubble, both in private sector in private sector and commercial buildings, but also in private housing, for individuals. So this had been going on for about 10 years or more. And then in 2007, as happened all over the world at the time, construction began to slow down because people, I think, were realizing that there wasn't that this bubble couldn't go on forever. The banks were realizing, for their part, that they couldn't keep lending money at that rate forever. That eventually there'd be more than they could, afford to lose. So it was a turning point. And in the Irish context, the impact of Lehman Brothers was felt quite swiftly. On September 29th, 2008, just I think 15 days after Lehman Brothers had gone, we had what was known in Ireland as Meltdown Monday. The Irish government had to take some controversial decisions that day, and the circumstances around those decisions are still kind of contested, right? They're still very controversial in Ireland. So what had happened on September 29th is that the Irish stock market had just basically collapsed. And the collapse had focused on the share value of two specific entities. Anglo-Irish Bank, which was a bank that didn't lend to private individuals, but actually lent to businesses. And another bank called Irish Nationwide. Both of them were known as commercial lenders, right? They gave loans to property developers, to people who wanted to engage in large-scale building construction projects. Now, fascinatingly, 6 months before this had happened, the Irish banking regulator had surveyed the banks and given them all clean bills of health. But clearly, on the night of September 29th, the government was looking at a meltdown of the Irish stock exchange, and they were having a crisis meeting and pondering how to prevent the total collapse of this bank, Anglo-Irish Bank specifically. but also Irish nationwide. Now, from the history of the 2008 financial crisis that the American government let this big bank, Lehman Brothers, fail. Well, the Irish government couldn't afford to do the same thing because Lehman Brothers, as a percentage of GDP, wasn't as big, proportionately speaking, as Anglo was to the Irish market. Had Anglo failed and been let gone to the wall, the Irish economy would have had a massive, massive hole in its circulation of credit, and the government wouldn't have been able to do that. Remember, Ireland had a euro at the time, so it wouldn't have been able to just print money and fix the problem as happened in the States. This would have been much more complex to do. It would have needed permission from the European Central Bank, and so definitely a lot of complexity compared to the American situation. So the next morning then, the Irish Parliament, it's known as the Dáil, D-A-I-L, in Gaelic language, met. They convened to come together to pass the so-called Credit Institutions Financial Support Bill. And it is, in global circumstances, a very significant decision for the Irish government to make, because it was the first time in history that a nation had committed to cover the liabilities of its entire banking system. And what that meant was that the Irish government was basically saying that whatever the liabilities of the Irish banks are, that is to say, whatever it owes the people that it borrows money, that they borrow money from, which are usually called bondholders. They're the people that finance the banks, so the banks can loan money in the form of mortgages and credit cards and car loans to us. So the liabilities were going to be covered by the Irish government. And so the Irish government had effectively said that it was going to take responsibility for 400 million euros in asset-backed loans, which was a lot of money. Now, by American circumstances, that might not seem a lot, but you're dealing with Ireland here, a country with less than half the population of the state of Ohio. That's a huge amount of money, right? It was 10 times basically the national debt and almost 2.5 times the national product. So, just to put that in proportion for you. So at the time, the prevailing view in government, however, was that nothing like that amount of money would be called on. The government would never need to actually give away that amount of money because the banks were not broke. They were having a temporary problem, what was known as a liquidity problem, right? They were just temporarily illiquid. The Department of Finance, the Minister of Finance, all believed that the fundamentals of the banking system were sound. And the Minister of Finance said, look, this isn't going to be a big deal. In fact, it's going to be and I quote, he said, the cheapest bailout in the world so far. And there'd been a lot of bailouts going on in the banking system around the world at the time. Now, subsequent events would prove this assessment to be wildly off the mark. So the Irish banking sector was, in fact, what's known as a zombie, right? It was not a liquidity issue at all. They were actually insolvent. So that meant that they would never, ever be able to pay off what they owed. These assets that they'd been sitting on were property bubble assets, and so it meant that these were buildings that basically were their assets, and these buildings had been valued, many times more than they were actually worth. As the value of those buildings sort of shrank back down to something more realistic, there was no chance that the Irish banks would ever be able to pay off the bondholders what they had said that those banks were worth. So by spring 2011, the bill for bailing out these banks, covering these loans, was actually already 70 billion. And what had supposed to be the cheapest bailout or guarantee in the world was actually now, according to the governor of the Irish Central Bank, being termed as the costliest crisis in history. At least one of them, right? So the consensus actually among commentators today, both critical and friendly to the government, is that the decision was definitely the most momentous taken by any government in the history of Ireland. Now, one of the big controversies that still swirls around the events of this period is the decision on the terms of the guarantee. Why did the government guarantee everything? So this brings us to the question of the bank guarantee plan. As it was known among some in government at the time, the David McWilliams option. Right now, we mentioned David McWilliams in the introduction. So the bank guarantee plan, many people had said, was devised by him, David McWilliams, because on the night of September 17th, Brian Lenihan, the Minister of Finance, had paid a visit to McWilliams' home. Again, remember, he's this rock star economist dude, right? So he's publishing every week in a newspaper, or maybe even two newspapers, his opinion about Irish economy and where the Irish economy is going and what it should be doing, how the government should be regulating it. So now there are different accounts about what happened that night and who initiated the meeting or what exactly was said between the two. On the part of the government, they claimed that Lenihan in fact consulted with a number of leading Irish experts in the economy at that time. But what does appear to be clear is that McWilliams was at the time working on a number of articles for Sunday newspapers and other newspapers that were articulating the need for some kind of resolution for the banks that would buy them time to separate out the good loans that they had from the bad loans. Now, some of them, as I said, were property bubble assets, and they were never going to be good again because those prices were never going to come back, not for generations. So you can just write them off, basically, or at least get a kind of a cheap deal for them. But then there were other assets that might have been better. So you couldn't let Anglo fail, because if you did, there would have been a credit crunch. So you had to figure out a way to take those bad assets off them. So that was his argument, right? Now, other countries might have tried to do what's called nationalization. Well, that's not really an option because you don't really know what you're looking at. The data on the health of the banking sector as a whole is not clear. So why would you take that risk? You don't know what you're taking on. So, the Irish taxpayer doesn't want to nationalize the whole thing, argued McWilliams. It would be too risky. Now you have another option, the so-called merger option. You could maybe merge Anglo with another large Irish bank, maybe one of the commercial banks. I keep saying I made a mistake there. The retail banks, which are the banks that deal with you and I. Retail banks in Ireland, there's two big ones: Allied Irish Bank and Bank of Ireland. So AIB and Bank of Ireland are the two big ones, and they would maybe be an option, but they were very weak too. Quite plausibly, right? So none of the Irish banks were really an option. You'd have had to have brought in a foreign partner to do it, to make it viable, and that would have required some kind of cash promise, a sweetener from the government to make that work. So the only option left, says McWilliams to Lenihan on the night that Lenihan comes to his house, is the so-called Swedish model. Now, McWilliams writes in his memoir of this night that, and so I call this the raw garlic session, because apparently the Minister of Finance was eating raw garlic all night long to keep him awake. He was very stressed out at the time, and he believed that raw garlic was going to be the way that he would kind of, power himself through this difficult moment. I guess some people drink caffeine, other people eat raw garlic. So the Swedish model was the model that McWilliams presented to the Minister of Finance, who was eating all this garlic at his kitchen table. And it was basically that because you couldn't nationalize and you couldn't merge, basically what you were going to do is you were going to guarantee the assets of the banks for a limited period of time, to make sure that what looked like was just a temporary dilemma, a dilemma of illiquidity, didn't necessarily have to become an insolvency catastrophe, right? Which would have meant that the bank would do a Lehman Brothers on it and just collapse and cause a credit crunch that would maybe compromise the entire Irish economy. If you have a credit crunch in an economy, that means that you can't go to the ATMs in the morning and get cash, right? Because there's literally a big black hole in the cash circulation of the economy, and it creates a lot of panic. So you really don't want that to happen. So now, as I said, there's not a lot of public information on what's happened here. But what we do know is that 10 days later, after meetings with international advisors, including Merrill Lynch, which was the consultancy company that was working with the Irish government at the time, but also after some pressure and phone calls from the European Central Bank President Jean-Claude Trichet, the Dáil, the Irish Parliament, passed a bill which was effectively this blanket guarantee. Now, controversially, Lenihan, the Minister of Finance, had told the Dáil, definitely, this is not an insolvency problem, it's an illiquidity problem. But he had said that without fully understanding the condition of the assets of the Irish banks at the time. So this move then was kind of like a throwing a dart at a dartboard, but in the dark, right? You think the dartboard's over there, but you're not really sure. So you might hit it, you might not, right? So he's not dealing with good data here. But interestingly as well is that the Irish government hadn't called up any of the other EU partners to figure out what they might have to say about it. It was just them and the European Central Bank and Merrill Lynch at the time. And of course, David McWilliams' advice, presumably, still a factor. This caused a lot of concern among the partners, among the partner nations of the European Union. Angela Merkel of Germany, Alistair Downing of Britain, were very upset, made very sort of dramatic statements in the media, saying that they were upset. Why were they upset? Because, well, if the government was going to guarantee all the Irish loans, no matter how risky, then Irish banks were going to start looking like a good thing, weren't they? So the Irish banks were going to start attracting in volumes of deposits from all EU partners because, if the Irish government is going to back up everything, then you probably want to start, throwing money at the Irish banks. And this already at a time when global markets are very unstable because of the collapse of Lehman Brothers. And we've had this credit crunch. The last thing you want is for a lot of global credit to start flowing to Ireland. So the guarantee was controversial. And it was also a turning point because it meant that what had started as a banking crisis was now a crisis for the nation, right? It was a sovereign debt crisis because the Irish state had basically put its own assets up as collateral against the potential of the loans of the banks going south. Very, very important that we understand that. Now, David McWilliams recalls being pursued by the media at the time with questions on the decision over the following days as the media believed that his newspaper columns were really kind of like the blueprint, the master key for how this guarantee would work. So they kind of thought that McWilliams was the master plan here, that he had the master plan, that he was the puppeteer behind the whole thing. But it appears that there was actually quite a lot of difference between the measure that ended up being decided upon and the measure that McWilliams had discussed with Lenihan on the night of the Garlic session. And McWilliams had always argued that, if you're going to do this, you're going to have a cleanup strategy that accompanies this. You're going to have to address the bank's balance sheets. You're going to have to sort of bring the banks into the government buildings, knock their heads together. And, in the national interest, you're going to have to also change their management, clean house, because you can't have the managers that oversaw this huge risk-taking beforehand, potentially, criminal acts of negligence. You can't leave them in charge. You're going to have to, for the reputation of the banks and for the reputation of the country, you're going to have new people on board. So that was all part of what McWilliams understood as the Swedish model. But it appears that this was actually not going to be the case, because even though the government had sort of put a 2-year timeline on this, it was clear that the state was planning to stay responsible, to maintain responsibility for the debts even after that timeline, that the management was not going to be changed. And worst of all, there was going to be no sharing of the burden. McWilliams definitely would not have advocated leaving these bondholders, fully promised everything that they had invested, especially the subordinated ones, because there's different types of bondholders, and we're getting esoteric here, forgive me, but there's bondholders that sort of pay for a guarantee, like an insurance policy, and then there's the kind of more speculative bondholders. These are called subordinated creditors or subordinated bondholders. They're the ones that kind of know they're making a risky bet, and they're the ones that understand that they're not insured when they make that bet. So why should they be guaranteed? And this is not something that McWilliams would have advocated. But nevertheless, this was the decision the Irish government made, that everything was going to be guaranteed, including the assets owed to the subordinated bondholders. So what happens next? Well, it turns out that what Lenihan had told the Dáil, that it was just a liquidity problem, was actually not true. Actually, the two banks in question, the two problematic commercial banks, Anglo and Irish Nationwide, were actually insolvent. And as this became apparent to the markets, their share values just tanked, right? They had lost 56 billion of their capital since February 2007. And this was going to be very, very hard to, if not impossible, to catch up on, right? So they were effectively insolvent. They would never be able to pay off what they owed. So the government basically then had three tasks, right? It needed to recapitalize the banks, to make sure at least the retail banks, the ones that deal with the small businesses and normal, ordinary, everyday people, to make sure that there's going to be cash in the ATMs in the morning. That's number one. Number two is they're going to have to deal somehow with all these bad assets of the system in general. Try to take up the bad ones and put them into some kind of national trust or national bank that could, wait it out basically until a good deal could be found for them. Hopefully, with the view that the other banks the banks that sort of the actual private banks could only on the basis of books with good assets in them return to profitability sometime soon. And then thirdly, specifically with Anglo, these commercial banks, right, which were different to the retail banks, the commercial banks find out some way to get them to service what they owe to the bondholders, right? So if you didn't do this, you basically have zombie banks. They would be on the hook for a very long time and possibly collapse the economy.